Well, good morning, everyone. I'm Dr. Laurie Davis, hosting today on the Today Show. Tuesday again, Ramin. Love it. Those Tuesdays just roll around. And welcome to Money Matters today with Dr. Ramin Modiri. Good morning, Ramin.
Good morning, Dr. Laurie. It's
How are
wonderful to be
things
here.
in California?
It's warm, but it's all good.
Yeah,
Yes,
yeah.
yes. It's August, and well, it's been kind of exciting August because, of course, we have Olympics. People are busy with that, and then, of course, it's holidays. People are, parents having their last couple of weeks with their children before the schools open, so they are taking some breaks. And of
Hmm.
course, we had stock market gave us excitement in the middle of all
Oh,
these fun and holidays. All of a sudden, the global markets decides, well, this is a good time to have the excitement and dive down. So
oh,
the
gee.
last few days, it has been, it's not just one place, all over the world. So, and
Oh, wow.
yeah,
Wow.
so a
Well,
lot.
you probably have some comments on that. We're streaming live right now on Laurie Davis Facebook page, our two YouTube channels, Laurie Davis, and there's so. Do you know, Ramin? Right now we're on 15 platforms altogether.
Wow.
I know, streaming live, and I'm going to send you the link because I received a link from your home TV, and they have published 14 episodes on your home TV. So that's American. That means we're out there, and they have between 20 and 25,000 viewers per episode on our charts. So those are my stock markets I'm looking at right now, those charts.
Good chart.
Good charts. And our particular show is very, very popular. And I think that's because you and I will talk about anything and everything, and including money. And we all know that people are gun shy sometimes about discussing finances. We've talked about that before. And some of those taboo topics, you and I are okay bringing those to the forefront. So let's see. We've got a couple of people who've joined us already live. Who's here this morning? Okay, it's Kathy Bell, and Kathy is our
Good
person
morning.
who sends our episodes to your home TV. So she sent the one particularly she liked when we interviewed Hastings from Malawi and the orphanage and all that. So that went down as well. And oh, she's going to send two more today. All right, excellent. I'm going to put that link up and on a banner, and then people can check out your home TV. All right. Well, what are we discussing today? I think you mentioned something about the word fun. And as soon as you said fun, I like fun. So, I perked up. How do you make investing fun or fun facts that you've researched about investing? So, I'm going to turn the mic over to you, Ramin, and take it away. And I'm going to put a banner up for the links. Okay.
Of course. Yes. Thank you, Laurie. Thank you, Kathy. Um, yeah. So before we start, about mention about fun, and I thought interesting facts, and probably is pretty timely because last few days, as I mentioned, the markets have had a pretty. It's not abrupt because it was expected, but it has been a pretty drastic downward pressure on them. And it's not just the United States. Everything has a catalyst, but things actually brewed inside for a while. And in the United States, for instance, the catalyst was on Friday. The job market did not meet the expectations. The employment rate went the highest since the COVID, so it's like the 4.3%, uh, and people are panicking, which it's really not a reason to panic, but it's a combination of things, and it happens. The slowdown. The concern is the slowdown in China. Then Bank of Japan decided to increase their interest rates, and it's the first time because they're the only bank. They want inflation in their economy to have growth, and the markets really dove down in Japan, in the Tokyo market. We're down 12.5%. So everything goes hand in hand. And that's what, again, as I mentioned, people are having holidays, they're enjoying life. It's warm summer days, and this is not what they want to hear. So sometimes it's good to be just away from all of this and come back in September and get back to reality. But people are in the business. Of course, it has been uh, pretty volatile, but also stressful few days. They're not used to this. And based on that, I thought, well, why don't we devote some interesting facts about especially stock market, some of the things that related, and hopefully some fun facts. So for our audience, when they see the markets drop like what we had like yesterday, that was the biggest drop in 2 years. They have to understand, put the things in perspective. For instance, in during the Great Depression, the markets dropped 71% in 4 years. Just imagine losing. That's what people, obviously, they were people who were committing suicide. And
Yeah.
then we also had this one. I wasn't around the Great Depression, but I was around for .com in late 1990 the 90s, and well, it was 2000, 2001, and .com lost 40% in just in 3 years. And we also had financial crisis, 2008, there was a global
Hmm.
financial
Hmm.
crisis. And in 1 year, the markets lost 38.5%. So, and when you lose that, it takes a while to come back. But also the other thing is we look at things just in numbers. We don't realize the people that's emotional effects that it has. People become gun shy, and we talked about the snake bite
Hmm.
effect last week
Hmm.
about the biases. So when the markets, let's say, go up since the financial crisis, they say, oh, we were up 100%. That doesn't mean our investors portfolios were up 100% because it took them a while to get
Right.
back in. So the markets might have had a bottom up and they went up, but it might have taken investors 2 years, 3 years to get back. So maybe they didn't make 100%, maybe they were up only 50%. So these are the things we have to take into consideration. Also, because of what has happened with so much of the interference, I would say, with the central banks and so much data out there, our economies are not organically behaving. What I mean by that, we used to have for like 100 years, we've had 18 recessions, and it's about
What?
five and a half years. Every 5.5 years, actually, the world goes through a recession.
Wow.
And that's a growing pain, but we all need to go through that and have the cleansing. And it's important because that's organic and we need to do that. But the problem is, in last 20, 30 years, the recessions have become a lot less. For instance, we only had recession after like 2001, and then we had the 2008, and then COVID was more of an environmental recession. So you see, like in 25 years or so, we only had 3 recessions, or every 10 years. The reason is, again, the central banks come back and start reducing the rates. They interfere. So it's almost, this is not real organic, there's synthetic economy because there's so many hands involved. So that's what has been a difference. Some of the worst years in stock market, again, because with what we had yesterday, put the things in perspective. The worst year we ever had was in 1931, and the markets dropped 47%. Almost half of your investment went down the tube. In 1937, the markets were down 39%. And in 2008, which is more recent, I think a lot of our audience remember that, we were down 38.5%. And these are very painful, painful years. So, having said that, let's talk about some fun facts, but it might not be fun for the recipient of this news, but it is interesting to know. So, these are kind of a trivia, but also tells you about the power of money and the power of stocks, how that can influence the decisions.
Hmm.
So let's start with our Apple story. Most people are very familiar with Apple Company. And what happened was in 1990s, in 1997 to be exact, Jill Amelio, he was the Apple CEO. So Apple stock all of a sudden dove, and it hit the slump, hit the 12-year low in 1997. And one of the reasons was because at that time there was a single sale. Somebody sold 1.5 million shares of Apple, and nobody knew who it was. And that really pressured the price of the stock. And later we found out this person who sold it was none other than Steve Jobs. So Steve Jobs, by manipulating, in a sense, by selling the stocks, he drove it down, and then he convinced the director to oust Amelio from the boardroom, and then Steve Jobs became the CEO. And that's how he came back, and the rest is history. So also in last few years, because of the technology, we've had something called flash crash, and it happens because of mistakes made or the technology is basically breaks down operationally. But I'll share a story. In 2005, there was this inexperienced trader in Japanese stock bank. And what he did, he went and tried to sell one share at 640,000 yen. So it was about $5,000. So, but when he goes to input the numbers, instead of selling one share at 640,000, he sells 640,000 shares at 1 yen, which cost the bank 3 billion yen. And that's, $3 billion actually. So just one mistake and the bank had to be behind it. So really, he sold like $3 billion worth of stock for $5,000. So mistakes like this happen. That's why you have to be careful, pay attention to details.
Oh my gosh.
Managements, because one of the old story, again, the same year, like, well, 1995 and 96, it's, Baring Bank, which was the oldest bank in the world, Scottish bank, Great British bank, it went out of business because one of its traders decided to take a big risk to cover up or make up for the losses that he's had in Singapore. And one trader brought this 300-plus-year-old bank, and that bank went out of business just because of one trader. And it was not, and we talked about risk management, it was not managed. So all right, so
scary.
Yes. So let's go to another story. You hear about bulls and bears, in the stock market, and you see, actually, if you ever gone to Wall Street and visited the New York Stock Exchange, you will see a statue of this huge, big bull in front of it. There used to be a bear, but that big one. Well, believe it or not, the name comes because of Caballeros, is called Spanish Knights in California. What they used to do, they put California grizzlies to fight with the bulls, and that was their entertainment. So that happened, and then they noticed these, again, Spanish Knights, Caballeros, and they noticed that obviously the bears swiped downward, they bring down, and then the bulls hooked upward. And that's how the analogy happens, that when bulls, we talk about looking things going up, and the bears bring things down. And that's what this is one of the stories how the name came about. By the way, that the whole thing that they did, it brought California Grizzlies extinction, the games that they were playing. So anyway, that's another tidbit. So now the other thing is we have September coming up, and this is for, again, our investing audience in stock market. Historically, September is the worst month. Since 1950, it, in average, has dropped over 1.1%. So be aware of that. Generally, Septembers are not a good month for investing. It's a good month in October to start actually getting back. But a lot of big crashes happen in, for instance, in October's. And there are many reasons. We've done a lot of study on that. But generally, Septembers are not a good month. So it's always to, the people are coming back from holidays, the schools are opening, end of the quarter. So basically, a lot happens. There's a harvesting season. There's a lot of different stories about that, but be careful as far as September goes. All right. So how are we doing so far? Do we any?
Yeah, well, let's take a little break, get your breath, and
Okay.
just want to get used to taking our breaks because we have sponsors lined up ready to come soon, soon, soon.
Excellent.
We're just creating them. All right, here we go. A little 30-second
Oh,
break. And while the break is on, this is an opportunity for others to showcase their business, their product, their event coming up. And I timed some commercials on television ahead of time. And you can say a lot in 30 seconds. I didn't
mhm.
realize how much you could actually say.
The day is set. Join us October 12th, 2024 at Carrigan Arms for our next fundraiser in honor of veterans, the Invictus Games in British Columbia, Canada, and TDC Employment Program enrollment. For more information, email us at info@thedisabilitychannel.ca. Introducing Veteran House Alliance International Monthly 50/50 Raffle. Purchase your ticket today, link on display, and have a chance to win cash and help a great platform supporting veterans.
Welcome back, everyone. You're watching the Today Show here on the Disability Channel. And of course, on Tuesdays, we talk money, we talk sex, we talk economy, we talk housing, we talk everything. So just tune in. And today, Dr. Ramin is sharing some interesting tidbits about the stock exchange and the stock markets and what's behind it and where the names came from. And so it's all very I won't use the word interesting because that's an intellectual word, but I just find it fascinating that the amount of research that you need to do in order to bring forward all of these wonderful pieces of information, Ramin, and we really appreciate that because there's time involved behind the scenes in order for us to present the information that costs our viewers nothing. And so please tune in. We're streaming live right now on Laurie Davis Facebook page, the Disability Channel. Episodes get shipped down to your home TV. So just join us and share the shows because there may be information that Dr. Ramin is going to share today that may benefit someone in your family or your friendship circle or your colleagues. And one of the things that I know about our shows, they're content rich. So any information that we give out, either from my side of the fence or Dr. Ramin's side of the fence, you can count on it that it's been tried, tested, and true. That I know for sure. So back to you, Ramin, for some more great stories.
All right. So the next story is about the relationship between wealth and how it's perceived. As far as, like, if you look at the old paintings, sometimes when somebody is really fair, is really haven't seen a light of the sun, that was a symbol of wealth. So a lot of
Oh,
times you see, like in a lot of paintings, is like really white. That means they don't need to be working on the land. They are protected. They are so wealthy. They have a place. And but of course nowadays, people they go sunbathing. They pay lots of money because they want to have the color now, because that's a sign of, oh, we have the time to vacation. We have luxury. So things go through ebbs and flows. Which that brings me to something that we've talked in the past, but that's called the hemline indicator. And it has some validity, but it's not 100%. It's more for the fun, I would say. And the shorter the skirt, the better the markets, the economy is. Basically, this thing They call it bare knees, bull market. So basically, the idea came, believe it or not, in 1926. There was a Wharton School of Economics. He was an economist called George Taylor. And he noticed when they are, in this case, females, women wear short skirts. That means they're having fun. The times are good. It's go happy go lucky. Remember, the 1920s was the year of course, extravagant the lifestyles and stock market is hitting the roof. And as a matter of fact, like in 1987, the hemline went down and we had a crash. So 1960s. So basically, that was the idea that, as I mentioned, when the economy is doing good, people are more relaxed. They like to show off. So, but the idea is that actually hemline is not the actually indicator, it's a consequence and lags about 3 or 4 years, by the way. So if economy is good, it shows up a little later. So it's not, but it's fun to know that it happens in 1920s. Again, go 20s, it happened. So again, the idea was that the shorter the skirt, the better the economy and the markets. So just be aware of that. On the other hand, when you look at the history, so when you go to 1970s, we had the middies.
Yes.
Also, we were covering our legs, and that was, and of course, 1970s was tough times. Everybody remembers we had the energy crunch, the OPEC embargo, and the markets were not doing it. And then, of course, we had Watergate, like a lot of bad news. So people were covering themselves. But the other side of things is, in the ages, actually having long skirt and long middies is a symbol of wealth, because you have to buy the fabrics, you have to be chosen,
Right.
you have the money to do that. So there's a lot of, again, there's always two sides of the story. So these are more of a fun facts than anything else. So I don't want our audience look for, go outside to any party and say, oh, there's a short skirt, goody, I'm gonna go and buy
Invest.
today. Yeah, there's a lagging, so it's fun. And speaking of that, and we've talked also about this in the past, is that lipstick indicator, right? And there's a lot of good validity for this. That we found out that when the times are tough, people actually spend money on makeups, and we call it the lipstick, rather than buying expensive handbags or expensive dresses. And Estee Lauder, it found out, when we had in early 2000s, the recession in the United States, their sales went up 40%. So a lot of people actually, what they do, they kind of want to relieve the stress by looking good and investing in actually lower expensive things. So we call that lipstick indicator, and that has been a good sign of finding out how the markets are doing. Another tidbit is, again, we kind of connect things, but sometimes means it's okay, but it's like it's anomaly, but it happens. Is Sports Illustrated swimsuit. So we found out that anytime an American model was the cover of the swimsuit, the U.S. markets did better than averages.
Oh, wow.
So S&P has done like 10.7% over 30 years. When you had an American model, it would do average at 13.9%.
Oh,
If it
wow.
was an international, non-American, the markets will do 7.2%. So, although the worst one, we had Marissa Miller was an American, and she was a cover of Sport Illustrated in 2008, and the markets dropped 38.5%. So things happened too. But anyway, these are just putting
Yeah,
things together.
wow.
So that was
Right.
interesting to know. One more thing, as far as we're talking about indicators, is, and there's reality. I mean, there is a basis for this. It's not about somebody being on the cover of a magazine, but we call that cardboard box indicator. And when the usage of cardboards are very high, it's above average, or things are, selling off. Well, that's a good sign of a health of economy, because now they're shipping goods. Things are moving, and obviously because of that, there's more boxes. I mean, you think about Amazon, the amount of
Oh,
boxes that they waste. I would say. I mean, you get like a little tiny, I don't know, whatever pen. Isn't this big box to be protected? Like, I mean, what a waste. But anyway, but it has actually ex head of the Fed or Central Bank of the United States, Alan Greenspan. He used to pay attention to that, and that one of the things that they were paying attention. So, for instance, in 2008, the usage of cardboards actually uh, dove 50%. It dropped 50%. And so these are more economic related. So, all right. So we move on to some of those tidbits. I just give you again for our stock market investors to tell them why most of the time we stay in the market, and why a lot of analysts or Wall Street, of course, they like you to buy stocks, because if you are in a cash, nobody makes money. So that's for the reason they kind of pump up the excitement of the markets. They want you to be in the stock market. But historically, believe it or not, S&P has gone up 55% of the time. So they have been up, the trading days that they've been up is 55% of the time. 45% of the time they're down. So you see there's a bias to being up and increasing. On average, it's about 0.2%. So what happens is it it is important to look at investing in stock market in a long run. So when you can long term, you see the biases are 55 up, 45 down. So naturally, it averages out, and you see the bias is positive. So that's why we say, especially the sooner you start, the better it is. That's what you can have advantage in investing in the stock market. And by the way, we've had the worst, like markets have been down like 8 days in a row. That's very anomaly. The markets don't stay down like 8 days in a row. Coming back to technology, of course, everybody talks about artificial intelligence. And in the past 10 years, believe it or not, robots have been the ones who do most of the trades for the big firms. And we call them algorithmic trading or robotic trading. And we were in past 20 years, they've grown, and it's 90%. Actually, right now, 95% of the trading is done by these robotic quant. So a programmer programs it. So it's not like someone like me putting, buying and selling things. Everything is done automatically, which what has happened, you can see the volatility all of a sudden during the day, things go up and down, or all of a sudden you see something, the market stops and goes the other way. Well, because they follow all these algorithms and a lot of formulas. So I think it's supposed to be by year 2030, we probably have 99% of our trading done by robotics. So
wow. Wow. That when you were talking about the cardboard, I was thinking about
yeah,
one of the things that has happened here in Canada is the elimination of plastic bags at the
yeah,
grocery stores. So you have to take your own reusable bags, right?
same here. Yeah.
To eliminate, land waste, landfill. But everything that I put on the register is wrapped in plastic. So my meat is in plastic, bread is in plastic bags. My grated Parmesan cheese is in a plastic container. So, is there any information around that that's a connector in terms of usage? And yes, the boxes. I ordered 2 boxes of business cards. Now you know the size that would be, and a little poster, and the box was taller than I am. I mean, I know I'm not very tall, but that was a tall box, So um, we do have a question from Virginia, which is a good one.
Yeah.
But yeah, that whole thing, how if there would be any connect. So I'm just putting that out there. All right.
Yeah.
Because when we have those types of changes, there, like you said, there's usually something behind that. Like that's a huge big. And where do I leave my grocery bags when I go shopping? Either at home or in the trunk of the car when I'm at the
Yes.
grocery store. And I don't want to buy any more of those cloth bags. Maybe I should start taking cardboard boxes. That might be good. All right, we'll be right back after this message, and then we have a couple of questions on the board here for us.
Oh, sure.
Okay.
The Disability Channel would like to thank our existing sponsors. We really appreciate the support and kindness from the BIAs across the GTA, Ontario, Canada, and our friends in the USA. We love making new friends. Thank you for supporting our existing employment programs.
Welcome back, everyone. You're watching the Today Show here on our Tuesday Money Matters, and today we're talking fun facts about the stock market and names and labels and what ifs. And Virginia has a very good question. So would you like to take that question right now?
Please.
Dr.
Yes, sure.
Ramin, what would you tell people to look for with these wealth grown plan educational websites that are popping up out of curiosity? And one of them is called Prosperity Academy. So are you familiar with those online, and what could you share with us about that?
Absolutely. Thank you, Virginia. Great to hear from you. Yes. So obviously, because of the technology, we have the social media, a lot of, again, accessibility to information, these educational academies and websites, and a lot of actually like YouTube segments, they're becoming very popular. What has happened with that, though, and there has been some investigation now done, because of the marketing side of things, these, which is started with the right way, with education in mind, they want to have the effect of the excitement, again, the marketing side of things. So now, in order to attract subscribers, to attract the attention, they becoming extravagant. All of a sudden, they're advising on which stock to pick, or some of the cryptocurrencies. They come up with an analysis of different markets that they have no business of being, and now there's a lot of actually slap back or whiplash back at them, because they wanted to create excitement to get more, again, audience, rather than being pure education. So in order to have the education, and there are more coming up, the idea should be that, I hate to say it, education when it comes to finances is boring, and it's meant to be. It's like, being engineer, it's tedious time, but you want to have a fundamental understanding. The goal of the education, which it comes from educe, is within. It allows you to become independent. So it's not supposed to be a dependency tool that hooks you up. So every day, like a drug, you got to be attached to it. The idea is you want to learn the foundations and the fundamentals of investing. And once you learn that, you can apply it to all kinds of, again, markets. But once you understand it, then you're not dependent, you're independent. And that's how you test it. You want to have courses that they are, a lot of actually universities now, they're putting value on that. They never did before. But at the end of the day, as we shall see, you see even college students, MBA students, and I've lectured many of them, and they come out, they still have no clue, because they're not streetwise. They've learned some theories, but they never applied it. And the idea of education should be the application know-how, not just learning about, the theories of it. So, but it is coming more and more because there's more demand. The problem also, I have to say, and I leave it at that, is to just, because of just so much media, everybody can set up a YouTube channel. So everybody has an opinion. The idea is it should not be opinion, it should be fact. and it should have a foundation. So, I mean, my son, the 17-year-old, can come up with his own channel and start giving advice on all kinds of things. And people, will go for that. But the idea is, how valid is it in the long run? And that's how you differentiate it. The credibility is important, in my opinion. So I hope that
Cool.
that's helpful. So
Yes, that makes perfect sense, because if they're up there and they want to create that codependency, then beware. That's what I heard you say.
exactly, and
Yeah.
that's why they have millions of subscribers. But then they have to create even more excitement. And as I said, quite a few of them are in trouble right now. A lot of these YouTubers, they are
Mhm.
not. They started as an educator, and now they are, giving advice, which could be, they can get into legal problems with the FINRAs and other authorities. So, yeah.
Virginia has a nice little fun fact here for us as well.
Okay.
What about those paper straws with the plastic cups? Right?
True.
Yeah. Where's the credibility in that? So
Yeah.
yes, for sure. All right, over to you. That's seems to be most of our questions.
Okay.
Yeah, okay.
So speaking of education, well, I'm going to move into the types of investors, and it probably would make sense now, but we are trying to change that. Is actually there are more men than women are active as stock investors, and we can come up with many reasons. Obviously, there is that economic side and the independence versus dependence, the value of the financial education, the nurture versus nature, uh, the side of the responsibility as a parent. Most of the time women are the caregivers, and so they don't have that. From the nature point of view, men supposed to be the hunters, so they take these risks. So stock market is glorious and fun, so they like to do that. Women are more protectors, so they don't like to take as much risk. So those are many reasons, but they are becoming more and more involved. We are getting more fund managers, more analysts. They're female, and they're more uh, women who are working. They are actually getting interested in investments, whether it's stock market or whether it's bond market or commodities. So as a whole, at least in the United States, 21% of the women and 24% of the men, they have taxable investment accounts. Now, interesting part is there are 46% of married couples who have no dependents, or they have taxable investments. Almost half of the married couples, but when they don't have a dependents, they're the largest group of investors in stock market. When we go to couples with the dependents, it drops down to 36%.
Hmm.
And again, it comes back to of course, we have the expenses, the children. So there's not enough discretionary funds. And basically, that's what the drop happens. But then when we go to single males versus single males, there's 27% of males, they have investment accounts, and 23% of females without dependents, they have have investment accounts. Only 15% of single females with dependents, they have investments. So we can see how it rolls down, because again, there's a lot of responsibility, and they cannot really they look at this as a risky asset. But again, in the long run, it might work out, but that's why they don't have the discretionary funds. As far as the generations, believe it or not, millennials are the least invested of all the generations. So we have Generation X and Zs, they are more involved. And one of the reasons for the millennials, poor millennials, they've gone through the dot coms. They graduated in 2008, right in the middle of the financial crisis. So everything, they're really gun shy. And it goes back to the snake bites effect. The other thing is that 10% of the Americans, they own 84% of the stock market. Just a food for thought.
Can you repeat that?
Yes, the 10% of Americans, they own 84% of the stock market.
Oh,
So the
wow.
90%, the rest, they own 16%. And that's getting even heavy. When you look at the billionaires, we see that. So talking about the generations, isn't that interesting? The silent generations, they're actually bigger investors than the boomers are next. They're 39%. Then we have the Gen X at 29%, and millennials are only at 22%. Again, for millennials. So you see the Gen X's and the boomers, of course, they are big and they've been investing. They've seen good times. A lot of boomers got involved in 1980s. And imagine they had a 20 year of almost 20 years of a nice ride. So they've done well. And that was almost their peak of their career. So they've done well. So let's now move on. We talked about global. Let's see some of the largest markets around the globe. What is the largest stock market in the world? So obviously, it's the biggest one. This is as of February, well, almost beginning of March of this year, 2024. So it's about 4 months lag here, but it's valid. Tells you how large the U.S. market is. U.S. market is at the market cap is at $52.6 trillion. The size of the stock market in the United States. Out of that, we call something called Magnificent Seven. And that's one of the culprits right now. The markets are going down because the money is moving out of these Magnificent Seven, which are your Apples of the world, Microsoft, Amazon, Google, Meta, Nvidia, Tesla. Those actually, their size was $13 trillion. So I want you to keep that in mind. Those 7 companies were at 13 trillion. The second largest market in the world is the China or the Shanghai, and we have, or Shenzhen together, is 11.5 trillion. So after US, which was at 52.6, China is second at 11.5. And these 7 companies are bigger than the whole Chinese market. So just a
Wow.
food for thought. Then we have Japanese market at $6.5 trillion. India is at 4.4. Canada is at 2.6 trillion. Just a few ideas to let you know. Saudi Arabia is at $2.9 trillion. So speaking of that, talking about companies, I mean, you think about Apple. In 2022, in January 2022, Apple was at $2.8 trillion. That's one company. And the Canadian GDP was at 2.13 trillion. So Apple was bigger than Canadian and almost as big as India's, with 1.4 billion population. Apple was as big as India's economy or GDP. So that shows you the concentration and how influential these companies are and how consumer works. We talked about, again, the 1931, 1933, the market dropped 47%. So there's been big moves down and up. In 1954, we had the best year. The markets were up 45%. So I'm sorry, 1933 was the best. 1931 was the worst. 1930, we were up 47%. 1954, we were up 45%. Those are not bad years. I mean, just imagine, all you need is like one of those, and that should be fun. Talking about global, now this is another tidbit. It might interest our audience. We always think about U.S. stock market as being the greatest, the best. Obviously you can see the biggest. So I want to show you for past 120 years, believe it or not, the best performing market in the world, which as long as they've been around, was, I gotta put the drum roll, it was actually Australia. Australia was the number one performer. They were up 6.8%. And United States was second to Australia at 6.5%. Then we had South Africa was up 6.4%. And then New Zealand was 6.4%, and Denmark was 5.8%. So that's the reason we want to diversify around the globe, not just one place. So, and Canada, believe it or not, was number 6. Number 6 best performer. They averaged 5.5% in US dollars. So, a lot of people actually, especially in the United States, they invest. They have retirement accounts and invest in funds. They have managers who manage their accounts. Believe it or not, if you choose your own stock, there's only 1/3, 1 in 3 chance that you will beat the stock market or the S&P. So it's a lot of people, a lot of advisors suggest that you should do passive investing, buy like a S&P index as a long run, because in the long run, they become a better performer. Unless you're really good, talk about Virginia, talking about education and other things, unless you really have learned and you can do your own analysis and you are really serious, you're not just looking for tips. You're not, what is happening on CNBC today and tomorrow, looking for another news outlet or social media. If you do your own homework, you will do better. But if you're not, then it's better to use like indexes, whether it's global index. Vanguard has a lot of good funds. And one of the reasons that we suggest is that over the 10 years, 82% of the fund managers, the managers who manage your fund, and they're supposed to be the experts, 82% fail to beat the indexes, like S&P 500. So you can just buy S&P index yourself, don't pay anyone, and have your own fund and do better. And in 1 year, if you look at this was over 10 years, in 1 year, 61% failed. In over 3 years, 93% of these fund managers failed to beat the markets. And believe it or not, after 10 years, 43% of these fund managers are not even around to manage your fund. So just I know we always like to look at find a good manager and find someone who's going to manage our fund. Just be careful with the funds that you're choosing. So sometimes a lot of late John Bogle, the founder of Vanguard, he truly believed in passive investing. It's better. But as I said, if you're really good at it, you know how to find, yes, you can, especially in the shorter term, there's a lot better opportunities. But in the long run, the markets, when you look at the 10-year horizon, markets are always up when you look at the rolling 10 years. So if you have the patience, you have the time, it's better just find good indexes and put the money in for 10 years and invest in there. One of our suggestion is, you can do that and maybe take 10% and start taking risk and play it yourself and find things. But at least 90% is in a passive investments. I think unless we want more, this is my last tidbit, is what are the most expensive stocks around the globe?
Oh,
and
wow.
Believe it or not, the number one stock, this is as of yesterday when we actually had a bloodbath. So just take that into account. It was down 3.3%. The stock is at $620,000. That means one share, you have to pay $620,000. And actually, it was higher than that the day before. But That's our good old friend Warren Buffett's Berkshire Hathaway and his fund. So he has an A, and most of the institutions get involved with this. And then he has a B. But the A, it was at $620,000. When we go globally, translate to dollar, the second most expensive company in the world is called Lindt and Sprüngli. It's a Swiss chocolate maker. And this is, as of last night, was at $106,000 a share. So, and then, you come to United States, we have like construction like NBR, that's like $8,000. We have booking.com, which does the bookings and the travel arrangements. It's like at over 3,000. So there are stocks that they're up there, and Amazon used to be there, and they split to make sure that it's like a lot of retail investors could get involved with that. But yeah, so the most expensive stock is at $620,000 as of last night.
Wow.
Yeah.
And then it goes downhill from there.
Well, I mean, imagine how can you buy, that $620,000? How much money you have to have? That's why the volume is like 4,000.
Yeah.
And still, that's a lot. But that's about. But I always have a backup. If you have time, I can give you a couple more. I think we're close to the end of the show. So I just want to tell you, this is as of 2022, the whole global market capitalization was at $117 trillion, which we are much bigger now. But that's how big the stock market is. But when you put it compared to like foreign exchange, it's tiny. So the big money is in the currencies exchanging hands. So anyway, I think that's, I still got more, but I think the end of
I think our time is almost up.
Yeah, I think that time is up. So
we'll have to save it for another day.
Yeah, no, that's
Mr. Walking Encyclopedia.
I hope it was fun. At least something we could use. And
right.
Yeah.
Well, thank you very much for all of that, because it's for those of us who are novices as it relates to the stock market, you have a way of, taking something really complicated and making it easy for us to understand. So that's the magic in that. And we appreciate that, because a lot of us didn't grow up with parents who invested that way, or our education has been very limited, especially us girls. So thank you very much for all of that. You've been watching the Today Show here on the Disability Channel, and we'll be back in an hour with Mr. Doug Smith, Mr. Kurt David, professional basketball player from, I believe, somewhere now near Detroit. And we're doing our sports show called The Press Box. So if you haven't seen The Press Box, it's a lot of fun. We do a lot of bantering back and forth. And of course, our host, Mr. Doug Smith, former NHLer, very interested in the health and care and trauma recovery. That's been his area since he was hurt playing hockey. So a fun show coming up in an hour, and we'll be back to do that. So have a great rest of the day, everybody, and thank you for joining us. And we really appreciate the support. So just please share, share, share. Bye for now, everyone.
Bye. Thank you.